Hello, everyone. Thank you so much for joining us for our final winter session webinar. Once more, my name is Ty Robinson. I am one of the community engagement specialists here at the Harvard Federal Credit Union. Thank you so much for joining us for another one of our webinars we're doing about financial topics. Today, we are doing quite a popular one, the Gen Z Guide to Wealth Building, with our very own Raj Bhanshali. I will introduce him in a little bit more depth in just a minute here. But before we jump into the content of today, I did just want to do a couple of bookkeeping slides. I'm sure you're all very familiar with the Zoom presentations at this point in today's day and age, but I did just want to make sure that I mentioned that today we are in webinar mode. And that means that the chat is disabled because we're going to do all of our questions through the Q&A feature specifically. This is going to help make sure that we have it all organized and we'll be able to easily address questions as they come in. Also, you are all automatically muted and cameras are off for attendees, so feel free to have your lunch, kick back and enjoy. You don't have to worry about accidentally coming on or making any sound or anything like that. I do just want to also let you know that today's presentation is being recorded. You're going to be able to find this presentation and all of our winter session presentations, as well as all of our other presentations that we've done over the years on our YouTube page. If you just go to YouTube and search Harvard FCU, you'll be able to find us. And you are going to get an email with both a survey link so we can improve our content, as well as the slides from today's presentation. So you'll be able to easily go back and verify and double check some of those slides and some of that info. A little intro to our community engagement team. I'm Ty. We also have Jen Fries and Terrence in the background. They're going to be helping with Q&A, putting some links in the chat, and just providing some backup support. We are a team that really makes sure that we are able to get out there in the community and increase our community presence, find different ways to help out and increase our presentation content through feedback and stuff like that. One of those things, that's part of the things that we do as a credit union. So real quick, because this is the most popular question we always get, is what is the difference between a credit union and a bank? And I just want to touch on that real quick. So credit unions are not-for-profit financial institutions. So that means that we do everything a bank does: checking accounts, savings accounts, credit cards, loans, investment services. We do all that stuff. But because we are not for profit, that means that we are not trying to make a profit off of our members. All of our members are actually partial owners of the credit union. If you open an account with us, you're a partial owner. You are able to actually vote on important and big decisions that we make here at the credit union. And we are able to give back all of those things that would be profits to our members and to our community in a lot of different ways, whether that is through lower fees or lower interest rates, or no fees in a lot of cases for a lot of our products, or higher interest rates for savings of products. We have a high interest savings account, which is really great, and a lot of things like that. So we have a lot of community focus, a lot of great stuff. My whole team is that. And one part of that is today, we're able to bring you these wonderful webinars and presentations like we do for Winter Session every year. So thank you so much for joining us. I do want to introduce our expert for today, Raj Bhanshali. Raj works as a financial advisor for over 25 years of experience. Throughout his career, Raj has partnered with clients to help them identify their goals and dreams and then understand financial implications of the life decisions that they make. Raj is originally from West Hartford, Connecticut, and attended Northeastern University right here in Boston. Raj also works as a supervisor in the event operations for the Boston Red Sox. That's really cool. I don't think I knew that. That's awesome. At Fenway Park. And in his free time, he enjoys playing guitar and traveling. So, Raj, thank you for joining us.
Well, thanks for having me. I hope everyone's staying warm inside, and we're here to discuss what I think is a hot topic. So, yeah.
Cold day out there.
Yeah.
All right.
So welcome, Gen Zers. We're glad you were able to join us today. Hopefully you were on the earlier webinar as well and got some good advice from Shar. So really what we're looking at is wealth building for Generation Z. And a lot of feedback we're getting and surveys that have been taking is Gen Z feels like they're not in a great financial situation right now. They're, and it's never too early to start. So the fact that you're even on this webinar, that's a good sign, right? So, there are steps that you can take in getting you on the right path. And hopefully we're going to cover some of these topics today, and you guys will learn a little something about that.
Awesome.
So, yeah.
Cool. All right. Do you want to hit on any of these on this slide here?
Yeah. So, I think it's not just unique to Gen Z, but more so now. Income shortage. People feel that they're not saving enough to make money to live on. And, that's a common thread, especially the last few years with inflation being what it is. Cost of living, especially if you attend Harvard, around Cambridge and Boston, cost of living has exceeded what other parts of the country are experiencing, right? So a lot of it has to do with supply and demand. There's also Gen Z feels that they're not confident that the money is going to grow in terms of the inflation and cost of living and all that, right? So, and then also, like, where do you find time to work and manage fun and things like that, right? So, and then coming out of school, you have a lot of debt, right? Student loans are been notorious the past few years. So there's debt management, trying to find a place to live, making sure your income goes and you can stretch it out as much as you can. So these are all concerns that we feel that Gen Z has, and you're not unique. Everyone feels this, right? So
yeah.
I was
just saying, I was reading recently that I think Boston is the fourth most expensive city in the whole country, which is a little wild.
Yeah, and if you look at that, like, the places you want to live, Boston, LA, New York,
yeah,
San Francisco, Seattle's up there, right? So
yeah,
probably like the places where all the great jobs are going to be very expensive to live, right?
yeah.
So yeah. So, but in order to get ahead of these things, is what we're here to talk about.
Yeah.
Having goals are important, right? So even if you're just still in school, you want to start thinking about the future. If you're about to graduate, even more so, you want to think about the future. So having goals in mind, because that goes a long way to like how you can plan for your day-to-day living, for your retirement, for purchasing homes, if you ever decide to start a family, if you haven't already. So having those goals are important. So as you can see on these slides, what the three most important topics for Gen Z is, you're working, you want to have fun, so travel and vacation, right? That's always,
Yeah,
you can't be all work and no play. Right?
that's true.
Building up emergency funds, that's a great thing to have a goal in mind for, right? So we talk about this in financial planning. You always want to have some sort of emergency fund built into what you're doing, and then retirement, right? The old standard tradition or adage was you work until you're 65, and then you go retirement and collect Social Security, and maybe you have a pension, but that doesn't work anymore, right? In the new economy, some people can retire when they're 45, 50. I haven't seen that yet, but I hope to get there. Or in my case, I'm going to work until I'm like 70, 75. So depending on like what you think your retirement lifestyle is going to look like and how you're going to fund that, you got to have these goals, right? So even if it might be 30 years out, 20 years out, or even 10 years out, you got to have some sort of idea, like a roadmap to get you to where you want to get. Right?
Yeah, and I'm glad that we talk a little bit here about the emergency fund. We do have a statistic that about 56% of Gen Z do not have enough savings to cover 3 months of expenses in case of an emergency. And I'm glad that we're just going to highlight this real quick, because I think a lot of this sort of like discourse about investing is like you need to be doing it early and you need to be putting a lot of money into it right away, especially when you're younger. But making sure that you have an emergency fund before you lock up your money is also really important. So just something that I think is worth mentioning.
I think that's key, right? So if you're just starting out, you don't have to hit all the buckets all at once, right?
Right.
So the important thing is you have a budget. You don't have to. I write it out. I keep it on an Excel spreadsheet. So, but just have an idea, like what is your rent going to be? What is your food and entertainment budget going to be, right? So on and so on. And like what you want to do is you want to start learning how to live on 70, 80% of what you're making.
Right?
Yeah. So, because the other 20% you can go towards savings or repaying debt or something like that, right?
Yeah.
Because what happens is in retirement, if you get Social Security or if you have a pension, if you're lucky enough, or in your 401k or 403, whatever those retirement qualified plans are, you're probably going to only receive 70 to 80% of your actual income in retirement, right? So if you can start off on that path right away, that's good, because then you won't feel stretched when you do get to retirement. Because like I tell all the people I meet with, the last thing you want to hear as you get to retirement, and I know for many of you this is like 30, 40 years off, but the end of the day is most of our goals are for retirement, right? The last thing you want to hear is when you're ready to, stop working, is find out you have to go back to work.
Yeah,
Right.
that's true.
So yeah, so a lot of that goes to like how you can manage your budget and live off that, and also like how do you minimize your debts, right?
Mhm,
So,
mhm.
and these are things that we would like to talk about, right?
That's great. All right, let's talk a little bit more about defining a financial goal.
Yeah. So whatever that is, right? So, um, when I was 16 years old, I got my first real job. And my father said, what do you want to go to work for? Well, I want to buy a Camaro. That was my goal, right? So, um, I never got that Camaro, not because I didn't work hard enough, but my father said no. But that's a different story. But you want to start defining goals. Like, what are you saving for? What do you want to buy? And how much will it cost? And like, what are those timeframes? So, especially when it comes to investing and saving, you want to know like what the money is going for, right? So, like, if you're looking to graduate in 3 months, 4 months, and you want to save money up so you can move to a different city or move out on your own and get like your own apartment or maybe even buy a house, right?
Mhm.
You just want to know what are you saving for, because depending on what that particular thing is, you're gonna use your money or handle your money differently, right? So like I said, if we're talking about retirement, if it's 40 years from now, well, you don't have to like be as conservative or mindful that you need the money right away, right? So there's certain tools that you can use for retirement versus, moving out in 6 months or buying a home in 3 years or starting a family in 10 years, right?
Mhm.
And then, that comes in with the time horizons, things like that. Then how much will it cost, right? So, if you're looking for a down payment on a home, it might be like $100,000, right? So
Mhm.
how do I get there? Like, how do I save for that? Or, maybe if you're moving into your first apartment, you just might need first month's and last month's rent, right?
That's
So
true. Yeah.
that's a lot different than saving $100,000 for your first home. So you want to have these things in mind, like defining that goal. What are you saving for? When do you want it? And how much will that cost, right? And that
Yeah.
goes a long way.
I like that a lot. I always try to also recommend writing down the goal because putting it out there in the world, like physically, can actually really help make sure that you're making a plan for it. And something else I wanted to mention is that even when paying off debt, whether that's like a credit card or something like that, it's always a good idea to have a strategy for saving also at the same time, because you don't want any unexpected expenses or emergency expenses to put you back further into debt when you're paying off that debt, like a credit card debt or something like that.
Yeah, and that's good advice, right? Because for the most part, we're always going to have some kind of debt, right? So
Mm-hmm.
it could be good debt or bad debt, but we're always going to have some sort of debt. So you can't say because I owe this much, I can't do anything for savings or investing or things like that, right?
Mm-hmm.
So
All right, so what are some, let's talk a little bit more about how you can start achieving some of those goals, right?
yeah, so again, like I said, if you identify what the goals are, what they cost, how long you have until you achieve that goal,
Mm-hmm.
like how much to save, what accounts to use, and investment strategies is all important things, right? So
Yeah.
again, as I said, if you're saving for something short term, like a new car, moving into a new apartment, you kind of have an idea of what that would cost, and like you don't need to risk those monies right away, right? Because
Mm-hmm.
if you're going to look to buy a car in 4 months, or you're saving for a trip in 2 weeks, right? You don't want to tie that money up in then what we call like
Right.
risky assets, right?
Yeah.
So like have an idea how much you need to save, right? But if you're going to start working after graduation in May, June, and then your goal is to buy a home in 10 years, right? Well, how much do you need for that down payment? Like, where do you want to live? What are the average housing costs and all that, right?
Mm-hmm.
So how much do I save? So, like I said, if you need $100,000 for a down payment and you want to buy your home in 5 years, you might want to start trying to save $20,000 a year, right?
Mm-hmm.
To achieve that goal. It doesn't have, these aren't all, it's not etched in stone where you have to do it, but these are just ideas, right?
Mm-hmm.
And then what account to use, right? So again, if you're saving for a trip in 3 months or 2 weeks or a car in 4 months, whatever, you probably want to stay in short-term liquid, like cash, savings accounts,
High yield savings. Yeah.
things like that, right?
Yeah.
Where you're going to get a little bit of return, but not taking on too much risk.
Mm-hmm.
But again, if you're saving for a home in 10 years or retirement in 40 years, you want to be in like a little bit more risky in investments and things like that, right?
Mm-hmm. So yeah, that can actually lead to some difficult to navigate things, such as competing priorities, like what's most important. Um,
Yeah, and it's never going to be perfect, right? So, as I said earlier, like even as you get through school and things, like we're always going to have some sort of debt, either a mortgage or if you're trying to finance or planning for education, like grad school or something like that, credit cards, things like that. Unfortunately, our society is built on debt, right? You
Mhm.
probably hear about like what the national deficit and all that, but that's how the economy runs. But you have to sort of prioritize like what's most important for you, right? So, and you can have many different things happening at the same time. So, like for example, I have credit cards that I pay off, so I don't carry that debt.
Mhm.
But I was paying off my mother's mortgage for a little bit, so that wasn't a priority to pay off because a mortgage is what we consider a good debt, right?
Right.
But at the same time, I'm trying to save for my retirement, and then at the same time, I'm trying to save like we talked about emergency funds and things like that. So short-term spending and things like that, right? So
Mhm.
you just want to, you kind of want to have your hands in all different things, but at one point you say like I have to give this up for something else. These are things that you can talk about with me or anyone, right? But
Mhm.
you just don't want to be all or none. Like I want to focus on paying off my student loans or my mortgage or whatever that is, my
Mhm.
credit cards, and then start saving. Like you can do a little bit of everything all at one time.
Yeah, that's good. And on some of these slides, there's a lot of like more information. We're not always going to hit on each and every single one of the topics just to make sure we have time for questions at the end. So we're gonna, but don't worry, like I mentioned, you're going to get all of these slides in a PDF and a follow-up email after today's presentation. So you'll be able to like review some of these more specific sublines. All right, so competing priorities considerations.
Yeah. So like again, we get this all the time. Like, do I save for retirement? Or do I create an emergency reserve? You can do both. Do I save for retirement? Or do I pay off debts? Well, you can do both.
Mhm.
Do I save emergency funds or do I pay off my debt? You can do both. And then you can do both, right?
Which is great.
So,
I feel like it's so easy to fall into the trap of you have to do one thing, you have to pay off all your debt, or you can't save. And again, we recommend both starting to pay off debt, but also making sure you can save some money for extra unexpected expenses or emergencies or that kind of thing. Because if you have a lot of credit card debt, you don't want to be only paying off that debt, and then if something happens, you have to put it right back on that credit card, and suddenly you've made no progress, right? It's always a good idea also be saving. Even if these numbers and how much you can do is a smaller amount, you always got to be trying to find that way to be able to do all of the things.
right. And we're going to talk a little bit more about emergency savings, emergency reserves. I call it a rainy day fund, right?
Yeah.
So, in planning, the adage is to have 3 to 6 months worth of expenses in hand, right? But a lot of people get confused. So, like, let's for example, my monthly expenses are around 4,000, 5,000 a month, right? So by that adage, I should have $30,000 in an emergency fund. Well, yeah, on paper that's true, but in reality that's not, right? So you don't have to have it all at once, but if you're starting off slow, if you have a couple of $1,000s and you just continually add to that every paycheck, my father used to tell me always take 10% out and put it in savings, right? So that might not be steadfast as well, but you don't have to have $30,000 right away for an emergency. In my case, right? You can take steps, right? Because I still have other things I need to prioritize, right?
Right.
So, yeah. So usually it's 3 to 6 months, but you don't have to get there all at once. It takes time, right?
Yeah, and I think the important part is just making sure you do have some emergency reserves, right?
Right.
Like it can be 3 to 6 months ideally, but like however much you kind of feel like will give you a nice bubble, and if some is better than none, right?
That is correct. Yeah, and then depending on your situations, you'll have different amounts, right? And then get this as well, like where do I put those emerging funds? Well, again, you want to establish it first. So usually the best place to start is with a savings account or a checking account. Some people use their checking account for cash flow and emergencies, right? Which is fine, but you just want to make sure if it's really truly an emergency fund, rainy day account, you keep the funds liquid, right? So the last thing you want to do is tie it up in some sort of investment or something that's locked up, like a CD or something like that, right?
Yeah.
And CD is certificate of deposit, where in case you need to raise those funds or access those funds, you're at risk because like the markets could trade down, or a CD is like something that you have to have a period that's locked up for, right? So you have to break that CD, right? So first you want to just keep it in a very liquid, like checking or savings account, and then
Make sure you always have access to it.
Exactly. And then as it starts to grow, as it starts to build up, so like say, in my case, I keep $25,000 in an emergency fund. I know most likely I'm not going to access all $25,000 at once.
Right.
So then something like I might peel back and take $20,000 and put it into like a high yield savings account or a money market account, right? Not worrying about what those returns are, but knowing that it's there and getting something, because again, I'm not going to use all 20,000 or all 25,000 at once, right?
Right, right.
But in case I do need to access it, I can pull it out, right, without
Yeah.
penalty.
That's great. All right, let's talk a little bit more about managing debt.
Yeah. And then again, as I was saying earlier, our economy is built on debt. That's how the whole capitalistic structure works, right? That's why credit unions in existence. That's why banks are in existence. Debt is not a bad thing if you manage it, right? So there's good debt like mortgages. Student loan debt could be a good debt if managed properly. Then there's sort of like what we call bad debts, like credit card debts and things like that, right? So let's talk about it, because I remember when I came out of school, I went to Cancun one too many times, so I came out with a little bit of credit card debt. So what you want to do is, if you do find yourself like having to manage bad debts like credit card debt, you want to find out what your interest payments are on each card, right? And you want to start paying down those higher cards, right? So for example, right now, we're in a very high yield environment. It's coming down a little bit, but if you look at your credit card bill, you'll see like the rates start charging are almost 35%, right? So you want to start paying down those higher ones, and maybe like look at rolling into like zero interest cards if you can, and things like that. But always target, like when you're managing debt, know if it's good debt or bad debt, and then start targeting the higher cards first, right? So a lot of times when as I start meeting with members, they have mortgage payments. It's a 30-year mortgage usually, right? And their interest rate might be 3%, but they're focused on paying off that mortgage right away. I'm like, no, that's silly. Again, this doesn't apply to everyone, but if you have a 3% mortgage, you can do other things with that cash, right? And probably get better returns than just paying down the mortgage. And again, as we talked about, mortgages are considered good debt.
Right.
But, if you have $100,000 in credit card debt, well, yeah, maybe you want to start targeting that, take that down first before you start investing, right? So, and then also, like, you don't want to overextend yourself when it comes to payments, right? So just set up a payment plan that you work out yourself in your head, and make sure it's something that you're comfortable doing, right? And like I said, you just want to start figuring out like where you want to attack it, have that strategy, and then how long will it take you to get there, right?
Yeah, there's a couple different approaches here. So especially if you have like a lot of credit card debt on different cards and things like that, there's a couple different ones you can do. You can either tackle the lowest balances first, like whichever cards you owe the least amount on, and pay those off. So that way those, debt amounts are gone. Or you can start with the highest interest rate, which generally is a little more recommended, I think, because the higher the interest rate, the more extra you're gonna end up paying on that. So you want to tackle that first, pay those off, and then go down to the next one. So
right, yeah. So it's just thing like being in an ocean, debts are like sharks, right? They're just going to feed off everything.
Right.
So, yeah, my approach is always to tackle the highest ones first. So you might have a credit card with $1,000, but you also might have a credit card with $10,000, right? So, but if that $10,000 card is like at 15%, but the $5,000 card's at 29%, I would go after that $5,000 card first, right? And then what we can do is what we call the waterfall effect. So as you start paying down some of these other ones, whatever you're doing, like paying the minimums on the other cards and making a bigger payment on the larger card, that money that you save after you pay off that debt, you start filtering into the other cards, right? So then you do that same. So it's kind of like a waterfall, like it starts cascading down.
Yeah, and once
right?
you've taken care of some of them, you're going to be making big monthly payments and getting it all taken care of, right?
Exactly.
All right, and then the other thing we just want to make sure we mention is that you do want to make sure you're continuing to make regular payments to all of your debts, even if that's the minimum, if you're tackling some of the higher ones first, right?
Yeah, always make a payment. And if you feel like you're in trouble and you're going to miss a payment, call whoever handles that debt, right? So if it's a credit card, say like Capital One or something, call Capital One. If you're student loans, call the student loan company. If you have something through the credit union or another bank, call them and just talk to them, like see what arrangements you can make. But the last thing you want to do is just skip payments, because then that'll impact a lot of different things in the future.
Yeah.
So.
All right. Well, we're going to start getting into retirement planning.
Yeah. So again, it's never too early to think about these things, and it's never too late to think about them. But given where this audience is, thinking about it now will have a lot of positive impacts on what you want to do for retirement, right? So you do have time on your side, right? And if I had 40, 45 years until I have to worry about retirement, if that's what your plan is, you can start putting away monies in um, some sort of retirement account, like an IRA account, Roth IRA, traditional IRA, or if you start working and your employer starts offering you retirement plans like a 401k or a 403b, right? Even if you put a little bit away, the compounding effects that it has on the overall returns will be tremendous, right? So everyone's always asking, like, how much do I need for retirement? Well, that all depends on what you want your lifestyle to be, right?
Right. Yeah.
But again, if you have something starting now, and if it's over the next 30, 40 years, whenever you want to retire, that'll be awesome. Right?
Yeah.
So
And there's all of this dialogue about just like the market's being in a rough place for Gen Z, sort of starting to figure out how to save for this. But they do have the great asset, which is time, right? They have a lot of time.
yeah. And like I tell everyone, the most important commodity that we have and people don't value is time, right? So, because that's something we're never going to get back, right?
Yeah.
And the benefit of that is, like, and as you learn a little bit more about investing, any kind of negative pullback in the markets, people always take that as a bad thing, but that's actually a good thing, especially if you're investing and you have time, right? Because what's happening is on these pullbacks, if you continue fund investments, and I think we talk about this at some point, is dollar cost averaging.
Yep.
What happens is it's like, one of my goals is to buy a Porsche, right? So if I went to the Porsche dealership today and my 911 is going to cost me $110,000, but something bad happens in the economy, I go to that dealer tomorrow and my Porsche is going to cost me $80,000. I'd be jumping for joy. I'm like, hell yeah, I'm going to buy this car right now, right? That's what happens when we get these pullbacks. Pullbacks are natural, they're healthy. These corrections, even though they're scary, but what happens is if you have time to overcome these pullbacks, which if you're saving for retirement at your age, you will. You're buying good companies, or you're investing in markets that will eventually go up. Because if you look at a chart of any index like the Dow, Nasdaq, S&P, these are all indices, right? They over time continually go up, right? So having that approach to your retirement, that's great, right? So time is your friend, right? And then always put an amount in that you're comfortable, right? So you don't want to, again, overextend yourself where you're putting too much into your retirement. Like, you don't want to become retirement rich, but then cash poor, right?
Right.
So
some ways you can start, right? Minimum, try to contribute enough to get your employer match.
Yeah. So like most companies will match up to a certain percentage. So even if you put like $100 a paycheck, especially if you're starting out, you probably won't even miss that $100, and you get two benefits there, right? The employer match, and it reduces your taxable income. So that's huge, right? And then if you over time feel that you can put a little more in, that's great. Do that, right? So you get those benefits, right? And then as you start to advance in your career, as you advance in your life, hopefully you're going to start making more money as well. So then whatever that is, you can split the difference between like what you're getting extra and put it into your retirement, put it aside for your emergency fund, things like that, right? But just do a little something, right? At least if you're working for a company that offers you like a 401k or 403b, you get that, right? And then, we talk about, wanting to retire at 40 or 50, right? Well, then, yeah, you're going to have to, this fire movement, right? You're going to have to figure out how to, unless you're going to win the lottery, figure out how to fund that retirement, right? So yeah, if your goal is to retire at 40 or 50, then you want to put as much as you can into those retirement plans.
Yeah, and in those cases, we really do. There's like a general recommendation for like figuring out how to continue to increase is to, when you get a raise, just continue to live off of exactly what you had before. Like, there's different ways you could do it, right? Like a 4% raise could be 2% more to retirement, 2% more to current needs. But if you are trying to be like more on top of that fire movement and stuff like that, you would want to be like, anytime you get a raise, just continuing to put all of the additional amount into your retirement as you can, and just trying to live off of whatever your original amount was, right? Because if you're already used to that, you don't need to do the lifestyle creep of like increasing how much your general expenses are, right? If you can do it at the start, when you make more money, you can just put that to retirement and keep living at the same level, right? All right.
Yeah, and these are just general rules of thumb, right? So you're gonna have to figure out on your own like what makes the most sense for you, right? But yeah, if you are fortunate to start working at 22 and you can start doing these things, 21, 23. Yeah, they're saying by age 30 you should have half your money saved. By 35, 1 to 2 times, or 1 to 1.5 times, right? All the way down and then at 65, because that's the ideal retirement age of 65, and
Mhm.
that has to tie in with Social Security and things like that, right? These are things that we can talk about.
Yeah.
But really, on average, you want to have 10 times your salary by the time you're getting closer to your retirement age saved in your retirement plans, right?
Yeah.
So, like for example, if you're making $150,000 a year, you want to probably have close to $1.5 million to $2 million saved in retirement, right?
Mhm.
And there are numbers and formulas that back that, right? So,
Yeah.
but again, these are all based on averages, right? But you have
Right.
to figure out your individual situation on your own.
Right. And investing wisely can be a great way to make sure you can reach some of those goals, right?
Yeah, and these are things that we'll talk about. And once you start investing, these are themes that you're always going to hear about: diversification, asset allocation, dollar cost averaging, which what we talked about earlier.
Yeah, and we're going to get more into the depth of
Yeah.
that in just a second here.
And then, retirement, like 401ks, IRAs, whatever those are great ways to have investments for retirement. But you can also do things outside of that, what we call taxable investments or non-qualified investments. So retirement accounts are what we call qualified investments. So that's a little bit inside lingo for you guys.
Mhm.
But taxable investments are also another great way, not just to save for retirement, but to save for other things, right? Just
Mhm.
general day-to-day things, right? So like, for example, we talked earlier, like if your goal is to buy a home, you can't really do that inside of a retirement account. So you can do this in a taxable investment, right? So
Mhm.
like, you're putting money aside. Uh, if your goal is in 10 years, you can start an investment program where, you're going to manage those investments for 10 years. So you have a down payment for a home.
Mhm.
Or if you're looking to buy a vacation home in 30 years, right? So things like that. So, and when we talk about taxable investments, we're talking about stocks, bonds, and cash alternatives, right?
Yeah. All right, so let's go a little bit more in depth about diversification.
Yeah, so there's that old saying, like, you don't want to put all your eggs in one basket, which is so true, especially when it comes to investing, right?
Mhm.
So diversification's key, and within that you have like asset allocation, things like that. But like, again, if you are talking about retirement, you'll think of diversification one way. If you're talking about things outside of retirement, you'll have diversification classified a different way, right? So,
Mhm.
like, again, if I was 25 years old and I was starting off looking for a way to save for retirement, I'd be as aggressive as I possibly can because I know I can't touch that money for 40 years, right?
Mhm. Mhm.
Like, you want to review it, like you just can't go in blindly and say, all right, for the next 40 years, I'm just going to be aggressive. But starting off, I would be aggressive.
Mhm.
But if I was 25 years old and I want to buy my first house at 30, my diversification model, my strategy would be a little bit different. Like, I want to be as aggressive, I want to have some risk involved, but I also want to have some protections involved, right? So diversification is a good way to, protect what you have against losses, right?
Yeah.
So, and like different buckets work at different times, like they'll do different things, right?
Right. Some will be more long term, some will be more medium term.
Exactly.
Yeah.
And this is what we talk about asset allocation, right?
Mhm.
Like, one of the best sectors to be involved in when it comes to investing, regardless if it's for tomorrow, 5 years from now, or for retirement 40 years from now, whatever that might be for you, is technology, right? But you don't want to put everything in technology. You want asset allocation because technology companies like Microsoft, Facebook, Google, X, those are all technology companies. They'll always lead the way up, but they also lead the way down too. So if we ever do get those market pullbacks, which does happen, those corrections will hit the technology sector first, right? So, or in a bad economy, like technology probably won't do as those returns won't be as well as we're expecting, right? So if you have stuff like, as we call consumer staples or consumer defensive, right? So like things like Coca-Cola, Procter and Gamble, things like companies like that fit those models, right? In certain times, they'll do better than like what Microsoft or what another company.
Right.
So asset allocation is key when it comes to how you invest, right? Again, you don't want to put everything in one basket, right?
Yes.
So you want to have different things working for you at different times.
Yeah.
Yeah, and then you want to use your investment strategy that works for you because not everyone has the same goals, has the same time frame, has the same risk tolerance, and risk tolerance is also important, right? So all that is how you manage risk, right? So for me, I think I'm aggressive, but I might have my definition of aggressive might be a little different than let's say my mother's definition of aggressive,
Mhm.
right? So like she thinks she's aggressive also, but she's very conservative, but in her mind, she's aggressive. But so you want to kind of know what your risk tolerance is,
Mhm.
but that should be based on what those pools of monies are for, right? So like we talk about being aggressive in your retirement accounts, because you have a long-term view for those. So if it's money for like a down payment on a home, we keep talking about, or like going on vacation and things like that, you don't want to be as risky or as aggressive, right? So you want to
Mhm.
ratchet that stuff back. So again, this is why we talked about knowing what the goals are, what the time frame is, what your risk tolerance is, right?
Yeah, and that's going to be different for kind of each person, right?
Yeah, it has to be, right? You're not going to
Yeah.
be the same. Like you'll be surprised how many couples or partnerships I talk to, they have different views on it, right? So
Yeah, I think a lot of people think there's like a quick and fast sort of just general like pattern that you can follow, right? But
yeah,
it
yeah.
really is going to
So that's
depend
why, like,
on.
yeah, investing is very personal, right?
Mhm.
And then, this is like a standard conservative allocation model, right? So, and this is what we talk about diversification asset allocation. Stocks are equities. With stocks, you become owner of the company. So whatever good or bad happens with those, you share
Mhm.
in that. Bonds, you become a lender to that company. So what that means is they'll pay you a certain amount of money each month or every 6 months or every year because they're borrowing money from you. So those tend to be a little bit less risky, right? And then cash alternatives will be like your checking and savings accounts, CDs, high yield savings, money markets, things like that, right?
Mhm.
So this is usually what a conservative asset allocation model looks like. But again, this is not steadfast, right? This is
Right.
just a general guideline, right? But again, you need to use your personal goals and things like that to manage, right?
Yeah, and
Then
then this is a the aggressive version.
right, yeah.
Yeah.
So you can see the change, right? More stocks because stocks are considered to be aggressive. Less bonds because bonds tend to be a little um, more conservative,
Mhm.
and then cash alternatives like you don't want to have too much cash if you want an aggressive model, right? So like again, this would be a perfect example for what you want your retirement allocations to look like, right?
Yeah, and just to compare real quick, as we can see here, the best year is 28.33%, which is, a good 8% higher than the best year here on the conservative model. But
Right.
worst year on here is minus 15%, minus 29%, right? So
Right.
those riskier ones, the more aggressive, sometimes it can be good, but sometimes it can be worse, right?
Yeah,
So
yeah. So again, it all is going to come down to like what your personal preferences are, right?
right.
And then like we talked about dollar cost averaging, right? So there are a few ways to think about this. I always use the example of again, back when I was in high school when I didn't have my Camaro,
Mhm.
I used to have $20 a week to go fill up my gas tank, right?
Mhm.
So regardless of what the price of gas was, it could have been back then a buck 50 a gallon or a buck 75 a gallon. I'm just putting $20 in, whatever that got me, right? So that's a form of dollars cost averaging. Every week I was putting $20 into my gas, and whatever that got me, that got me. So the same way with like your investments, right? So like with your 401ks or 403b plans, you're sort of dollar cost averaging into your investments, right? Because a percentage of your paycheck is going to go into those investments, right?
Mhm.
Outside of that, like, if you want to put $100 a month into an investment, like this is what it looks like. And,
Right.
this is kind of what happens, right? So as we're talking about, when you get these pullbacks in the markets, I think that's a good thing, especially if you're dollar cost averaging in, because now what's happening is you're buying good companies that you maybe wouldn't want to buy at a lower price. So
Mhm.
again, that only helps, right? So this is dollar cost averaging is good for like some sort of investment program that you're in, right?
Yeah.
So yeah, and it does work, right? And you can see from the table here.
Yeah. Very good. All right.
Yeah, and the other thing is, and we talked about this, today might make sense for you to be in an aggressive portfolio for retirement,
Mhm.
but you don't want to do that blindly, right? Because markets change, you're going to change. There are going to be times where it makes sense not to be an aggressive, right? So, like if we do get that pullback, I remember in building up to year 2000, there was that Y2K fear, right?
Mhm.
So, like portfolios in 1988, 1999 we were very aggressive. We were all technology because that's where all the growth was, right? But then after 2000, when we had that Y2K scare,
Mhm.
a lot of these technology companies failed because the world didn't fall apart, and some of these companies that were built on nothing, they were, people figured out they don't have no real product, right? So the market crashed a little bit, right?
Mhm.
So you want to have periodic reviews, check your accounts, you want to circle in and out of things. Because the last thing you want to do is like miss a run up because you didn't review your account, or not adjust because of a pullback and you miss things in your account, right? So it's always important. If you're working with someone, especially because that's their due diligence, their fiduciary responsibility to talk about these things. But if you're going to do it on your own, even more importantly, because you don't want to miss opportunities or be caught left behind because you didn't check your accounts and things like that. So you just can't fly blindly when it comes to it, having an investment strategy.
Yeah, I know personally for me, I just got married, which is awesome. But it is perfectly timed with this new year to take a closer look at my finances and reevaluate like how much I'm saving, how much I'm doing different things to, because it was like, oh, like now is the period of time before some of these other major life style changes that could come down the line to try to like save extra and like try to like be a little bit more aggressive with how much I'm able to save.
Exactly. And like things happen, like I said, outside of your control, like the economy, right? We just have a new president coming in. So that might change the landscape things. And we'll talk about things like that, right? And also, over the years, it's not a bad thing to take gains when you can, right?
Right.
Because that's how you protect your growth, right? So you want to talk about these things. That's why having periodic reviews and just checking in your account. You don't have to do it every day, but at least once every quarter if you're doing it on your own, or once every 6 to 9 months if you're working with someone.
Yeah, let's go. All right. Well, I do want to talk briefly about just some extra resources that we recommend that you use, and then we'll get to the questions that have come in. So one of those resources is our partner GreenPath. They are an awesome financial wellness nonprofit that does free credit and budget counseling, as well as like housing counseling and a number of other things. Whether or not you're a member of the credit union, if you are referred to them from us, it is free for you to go to them and have a counseling session. Because one thing that we touched on, but I really want to make sure I mention, is that everybody's financial situation is different. Everybody needs sort of different things, different help, has a different sort of rate at which they can save or invest or any of those things. And so trying to take this and apply it to your life without having a sort of more personalized like meeting with somebody is going to be hard. So what I definitely recommend is after this, if you need further help, either go to GreenPath if you need some of these other types of things, such as credit or budget counseling or housing counseling, anything like that. And if you want more personalized investment advice, you can set up an appointment with Raj. He is available for individual investment appointments, and is generally right here in Harvard Square at our branch at 104 Mount Auburn. So let's take a look at the questions and kind of see if we can help address anything specific here.
We do have quite a bit.
Okay.
Do you want me to ask you, or do you want to go ahead and
Sure. Why don't you go ahead and ask, just so it'll be a little bit more organized that way.
Okay. So first question is, what are retirement accounts, and are they different from a 401k, etc.? Can you only have a retirement account through an employer?
Yeah, so that's a great question. So retirement accounts like 401ks, 403bs, those are employer sponsored plans. So those are only offered through your employer. Then you also have like your traditional IRAs or Roth IRAs. And these are all just tax codes within the IRS. So when the money's going into these certain accounts, the IRS knows, well, this money should be taxable until a later date, right? But retirement accounts are designed for retirement, right? So just keep in mind, once the money goes into those accounts, most likely you're not going to be able to touch them until you're age 59 and a half, the way the laws are written right now. And then depending on which type of account you have, so usually it's your 401ks, 403bs, traditional IRAs. At age 75, you're going to have to start taking distributions, because again, these money that goes into these accounts, they go in tax-free, so the government's going to want to start getting paid, right? So hopefully at that age, if you can wait that long, you're going to be at a lower tax bracket. But in the Roth IRA, it's after-tax dollars that go into it. But then with the Roth IRA, you have some income implications. So depending on how much money you make, you might not be eligible for a Roth. But these are things that we can talk about on a one-to-one basis. But the money that goes into a Roth is after-tax dollars. So when you do take it out at the proper age, you won't have to pay taxes on that. So that's a nice thing too, because the way you want to look at it, all these accounts are tax shelters.
Right.
So, and the government doesn't give us many tax shelters, right? So you can get that deferred growth without having to pay taxes on it. That's huge as well, right? So especially, if you can start now and you have that 40 years of growth plus the tax deferred portion of it, that makes a big difference when we talk about compounding effects, right? But yeah, so depending on like what you're looking to do, you do have these retirement accounts available to you, but just understand once the accounts are established and money goes into them, most likely you can't take those funds out until at least age 59 and a half.
Yeah, and also just real quick, sometimes there's a lot of verbiage, right? Like Roth IRA, 401k. 401k is specifically through an employer, so that type of account will always be like through an employer, whereas some of these other accounts like Roth IRA or traditional IRA are retirement accounts that are not through a job that you can contribute to. Yeah. All right, Terrence, what's the next question?
Okay. How do I know I'm retirement rich and cash poor?
Yeah, so I'll just give you a real life example. I had a few years back, I had a client who had about maybe $5 or $6 million in his retirement accounts combined between him and his wife, and they wanted to buy a rental property in Miami. So he did such a wonderful job of putting money into his retirement. Did very well in his investment selections. Don't want to toot my own horn, but did very well, right? Overall that. But he was putting too much money into his retirement, right? So, and he worked, he was an attorney, so he was able to do other things like and this will get a little bit more technical, but like a SEP IRA and things like that, right? But he was just putting so much money into his retirement account. He wasn't saving outside of his retirement. So when it came time to buy this property that he thought was going to be a great deal, he just had no cash, right? So he would have to either find a way to borrow the money or raise funds through his retirement accounts, but then he would take penalties because he wasn't at 59 and a half yet, right? So that's what I mean. Like, you don't want to be cash poor, retirement rich. Like, so, and this is where you need to talk to someone about these things, right? So you don't want to put everything you have just in retirement and then find out you can't live the life the way you want to live it, right? So,
yeah, it's a good point.
Okay.
What's next?
So this is going back to what we were talking about earlier. Traditional and Roth have different tax implications. This person was told to compare their tax bracket now versus when they retire, but they have no idea. How do people think about their tax brackets now versus retirement?
Yeah, so again, this is all just going to be to your specific, right? So, but just in general terms, like if you go to the IRS website, irs.gov, they'll give you like what the breakdowns of the tax brackets are. Like if you make X amount of dollars or income this year, this is what tax bracket you're in versus another, like whatever those breakpoints are. So it's really you're guessing what that tax bracket, what those brackets will look like in 20 years, 30 years, 40 years from now, right? But the idea is as you retire, you have no income, right? So you're going to be at the lowest tax bracket, ideally. So when the money comes out, you're going to be taxed instead of like at 24 or 32%, you may be taxed at 15 or 20%. I can't give tax advice, so I don't know, but that's what you're looking at. So again, it's all going to be dependent on your particular situation. But most likely, if you're starting out now, you're probably going to be in a very low tax bracket, unless you have a really good job when you come out of school. But again, the idea is as you get older and get closer to retirement, and in retirement, your tax brackets will be a lot lower. But like I said, that's a big guess. 30 years from now, 40 years from now.
Yeah.
But most likely, we will stay within these brackets. I don't think we get to where we are in Europe, where 60% of your income, regardless of how old you are, is being taxed, right? So, yeah. But those are, that's why having that tax deferred, like a 401k or a traditional IRA, 403b is huge, right? Because you're reducing your taxable income now. And then again, the idea is as you get into retirement, you're just at a lower tax bracket.
Okay. There's also a link in the chat to the irs.gov to look at retirement plans.
Nice.
Next question. Is it wise to take money out of a Roth 401k, contributions only for grad school?
Yeah, I mean, again, it's hard to answer that in general terms. It really depends on your situation. But if that's your only way to fund it, then yeah, but it it all depends on like how much you're going to take out, like what does that mean when you're done with grad school? How old are you now, right? And things like that, right?
Mhm.
So there's always like that opportunity cost of giving up something later for now, right? So if you have money in a Roth and you know you have other ways to fund for grad school, I would consider that first. But if your only way to fund for grad school is a Roth, again, I would talk to a tax consultant about those implications, and then if that makes the most sense for you, do that, right? But it's hard to say.
Can you speak about what kind of penalties there are for taking out like money from a 401k before
So
you turn 59 and a half?
yeah, so generally it's 10% right off the bat plus whatever, because once you take a distribution out of these retirement plans, it'll count as income.
Right.
So then this is where we get back into what tax bracket
Right,
are you in,
that's fair.
So yeah, so but most likely that 10% penalty is severe. So you're basically giving away 10% of your money to the government for no reason. Right.
Mhm.
So plus then if let's just say if you're like most Americans, you're in a 24% bracket, right?
Mhm.
So that's almost a third of your money going away into taxes, right?
Yeah.
So even though Roth is after tax dollars, you won't have sort of that implication, but the penalty is still there. And I know like in some plans, you can take money out for educational purposes too, right? So,
Yeah.
But yeah, like I said, for that particular question, it all depends on your situation.
Okay, nice.
Let's see. I have a question on, is there a catch to high yield savings accounts? Why would you want a normal savings account instead of a high yield savings account?
Yeah, so there's I don't think there's a real catch to it, but it also depends on the institution that you're using, right? So like if you're like on one of these online institutions where they might entice you with a very high yield just to get your money, I would want to look more into that, right? Because sometimes they have periods where you just can't take the money out, or if it's online, you just can't find a way to get a check delivered to you or something like that, right? But if it's like a more traditional institution, the credit union here, I know we have our high yield savings, the smart reward savings as they call it here, or like a Bank of America or an American Express. The only thing to keep in mind is like with these high yield savings accounts or money markets, they tend to adjust when rates adjust. So when rates are going up, it's a great time to be in them. But when rates are going down, like we're in a lowering rate environment now, rates are still fairly high historically compared to where we were a few years ago, but they start to adjust down as well, right? So, for example, if you're familiar with Goldman Sachs and the Marcus accounts, their high yield savings was at 5.5% last year at this time. Now they're down to 3.85% APY. So they adjust down quickly. So that might be a catch to it too, but it all depends on the institution. But also, like if you see things that are just out of whack, like someone's offering you 7 or 8% versus when most people are offering you 4%, you might want to dig a little deeper and find out why.
Yeah. And actually, I can talk a little bit more about. So, like our high yield savings here at the credit union, generally it's up to $25,000 in that account. So they tend to have sometimes a limit on how much you can sort of get that benefit from to kind of make it so it's not like a long term like investing option, right? Because you can only get that extra high yield up to a certain amount or something like that. So there's like different sort of parameters where it makes it more worth it in some instances, and but generally has like a limit or something like that. So just something that's important is to like really make sure you get all the terms and conditions for those types of accounts. But yeah, in general, if you could find a high yield savings account versus a more normal savings account, it's probably best to go for the high yield option as long as you understand all of the terms and
Yeah,
conditions.
and that's a great point about the limitations. Like I know American Express, they'll offer you a higher yield at $50,000, but if your account balance drops below 50,000, you're not going to get that rate. Same thing happens with Bank of America. They offer you a high yield at $100,000, but if you drop below 100,000, so things like that. So as Ty was mentioning, just make sure you understand what you're getting into before you get into it.
Awesome. 3 more questions. What is the difference between a mutual fund and a hedge fund?
Okay. So just the very simple mutual fund is just a portfolio of stocks and bonds, right? So I won't go into the long explanation that I usually give people, but so basically a mutual fund will have holdings, say like 50 different holdings of, and depending on the fund, of like companies that you probably know and companies that you probably don't know, right? Whereas a hedge fund, that's a sort of investment strategy. So hedge fund managers, they're allowed to sort of do certain things in the markets that most traditional investors won't do. Like they can what we call a buy long, so like invest in a company, just straight investment like your traditional investment, or they can short companies like they believe a company's not going to do well in the future. So instead of owning the shares, they just sell the shares, hoping to buy it back in the future at a lower price. So there was that hubbub a couple of years ago with GameStop, and that's what drove the company into bankruptcy because the hedge fund managers were in there just shorting the stock, and they were just basically devaluing the stock, right? So just like with basic economics, law of supply and demand, right? If there's a lot of demand, prices tend to go up. If there's very little demand, prices tend to go down, right? So what they were doing is they were creating an artificial market to short the stock and drive the price down so they can buy it back at a lower price in the future. So these are usually what hedge funds do. So it's not generally open to more traditional investing. So there's some sort of parameters before you can get invested in a hedge fund. But a hedge fund is just basically what it is. They're going to hedge the market in some form, right? So if they think the markets are going to go up or companies are going to go up, they'll put money in as a long hold. Or if they think the economy is going to falter or companies are going to go down, they'll start selling those shares ahead of time and trying to buy them back. So mutual funds are more for traditional investing. Hedge funds are a little bit more exotic.
All right. I know we have a couple more questions. I do just want to make sure we get through our last couple slides here because there is an important sort of disclaimer I got to mention, which is that this is a little bit investment advice. Generally, I'm the one that's kind of leading the presentation and I can't give investment advice. Raj here can, so that's great. But these slides in this presentation is for basically educational purposes only. We give a great overview of all of these things, but if you want to know how this type of thing can relate to your own personal individual life, the best thing to do would be to meet with Raj or somebody else, or as he said, he can't give tax advice. We can't give tax advice either. So you'd want to meet with a tax advisor in that case if you need help with that kind of thing. Because really everybody has their own path in their own life, and it's going to be important for them to seek individual counseling as is needed with somebody in an individual appointment, right? And then I'll leave the slide up here with Raj's info. So if you want to go ahead and set up an appointment with Raj or anything like that, you can, as well as some of our other channels here as well. So maybe we have a couple minutes left. We can try to get to these last couple questions. And thank you all so much for joining us here today.
No, you're all good because they were already answered. You're good to go.
Oh, great. All right. Well, thank you, everybody, again, so much for joining us for Wintersession and taking your time out to meet with Raj here. I know he would love to have an appointment with anybody that needs some further help out there. So please don't hesitate to reach out to him or to set up an appointment. Thank you all so much for joining us. I hope that you were able to glean something from that. You know, it's a wild world out there with the finances, especially for people that are younger, trying to figure out what the path is. So I hope that you were able to learn a little bit more today. But we are the Harvard Federal Credit Union. Thank you again so much for joining us. Stay in touch with us or with Raj as is needed. Make sure you're figuring out different things in your life. And good job pre-committing some time today. Make sure you're taking a step in the right direction to figuring out the crazy world of budgeting, finances, wealth management, and all that stuff. So thank you all so much. Keep an eye out for us in the future. And you're going to get an email with the slides from today's presentation so you can review them at your leisure, as well as a survey link so that we can learn how to improve in the future. Thank you all so much. Have a great day and stay warm.